Hi, welcome to this tutorial. So in this today tutorial, we are going to discuss about profitability ratios. As we know, the profitability ratios are the measures which evaluate a company's to generate profit from its sales. In some cases, what can happen in companies, there are sales are growing, but with relate to the sales, sometimes the profit may not grow. So in this case, we have to evaluate the profitability of the business or profitability of the company to see where the problem exists is related to pricing or related to some cost issues, or to solve this issue we have to do some ratio analysis, some kind of ratio analysis that we call the profitability ratios. So what are profitability ratios? It measures a company's ability to generate profit from its revenue, assets and equity. The company, there are some assets or revenue already there in the company. So this profitability ratios measures the ability of a company to generate profit from its asset, its sale, its revenue, its equity. So this profitability ratios answers some questions. How effectively this company controlling the cost? Is the company is earning enough sales or enough profit with related to its sale or its investment in asset or equity? And how long this profit or this profitability can be sustained, or this is a temporary profit or it's a sustainable profit? So this thing is analyzing when we are doing the profitability ratios. The profitability ratios very important to analyze the income statement, especially the profit and loss account, and also some component of the balance sheet like asset, equity. And also the profitability ratios help compare companies across industries, and also it's help to analyze the trend in the trend of the financial performance. So the profitability ratios are very important for management to check the operational effectiveness and efficiency of the operations, for the investors to see how the return can be generated from this investment, and also for the creditors to judge or to analyze whether this company can repay their debt, or is there any issue with the repayment, or they have to expect some issue with the repayment. For the analyst especially, it's compare across the competitors, across the industry, and again comparing against the industry benchmark. So just see what is profitability ratio. We can go through this example. So in this example, there are two companies, both have sales $1 million, but a company A earns 200,000 as net profit and the company B earns only 100,000 as net profit. So when we looking into net profit margin in this scenario, the company A has net profit margin 20% and the company B has net profit margin 10%. So in this example, we can see that both companies are generating the same revenue, but its profitabilities are different, or the net profit is different. So in this case, we have to analyze and we have to see what is the reason beyond this low performance of company B. Because its net profitability is low, there are some pricing issues can be there, maybe something related to product mix or something related to cost control. So to do the analysis like that, where the profit falling or where we are driving our profitability, so the profitability ratios are really important. So now we'll move into some important profitability ratios. The first one is GP margin or GP ratio, gross profit margin. So gross profit margin show how much profit a company make after deducting the cost of goods sold. As we know, the gross profit is sales minus cost of goods sold. So the GP margin or GP ratio show, or it's showing how much profit, how much proportion of profit is generating when its GP is generating when it's compared to its sales. So the formula for GP ratio, gross profit margin, is sales minus cost of goods sold divided by sales into 100. So in this case, the sales will be the total revenue from sale of goods and services. The cost of goods sold means all the direct costs related to producing that goods, such as direct material, labor, and overhead. So let's look into an example. So there are two companies, company A and company B. Company A sales is 1 million. Both the company have same sales, that is 1 million. But the cost of goods sold for company A is 700,000 and the company B is 600,000. So in this case, the GP margin company A 1 million minus 700 divided by 1000, divided by 1 million, that is 30%. But when it's come to company B, it is 40%. It's sales minus cost of goods sold divided by sales into 100, that's 40%. So what we can interpret from this, these both companies are generating the same level of income, same level of revenue, but the company B is generating more cost of goods sold. But the company B is generating more gross profit. That means it can be related to its profitability or product profitability. Suppose the company is selling more product that is adding more value, or the company is effectively managing its cost compared to company A. So there are lot of reasons. In this example, we can see that even with the equal sales, company B is more efficient at managing its production cost. So why this is important? A declining gross margin may indicate rising raw material costs or poor cost control. If you are looking into trend, if there is a declining gross margin, it is an indicator of either the raw material cost, increase in raw material cost, or decrease in selling price, or can be the poor cost control. A high gross margin show strong pricing power or efficient operations, useful for analyzing manufacturing versus service industries. That means a higher margin normally indicate that the company has strong price point or price power, and is effectively managing or efficiently managing its operation by controlling cost and other through optimization methods. So the GP margin or GP ratio is effective or useful for analyzing in manufacturing, in service, in trading, in almost all industries. It is relevant. So now we will move into next ratio, that is operating profit margin. It shows the proportion of profit a company make after deducting its operating expenses like salary, rent, utilities and depreciation, but before interest and tax. It reflects a company's core operating efficiency. Operating profit means how much company is generating profit from its core business activities. That means after the gross profit, it is reducing the all operating expenses from the gross profit to calculate the operating profit. So the operating profit margin, what is measuring that? How much percentage of sales is the operating profit? So the formula for operating profit margin is operating income divided by sales into 100. So whereas the operating income, sales minus cost of goods sold minus operating expenses. EBIT mean earning before interest and tax. So let's look into the company A, the previous same examples. Let's assume the EBIT for company A is 150,000 and company B is 100,000. So in this case, the operating profit margin is 15% in this case and 10% in this case. So which mean in this case, same as the previous case, the both company have same level of revenue, but even when it's come to operating profit or EBIT and operating profit margin, company A is doing better because its operating margin is 15%, where the company B's operating profit margin is 10%. That means company A is more effectively managing its operational expenses and is effectively generating more gross profit when compared to sale company B. So next we will move to another ratio, that is net profit margin. Net profit margin, what is net profit? Net profit is the final profit that's available to equity shareholders after reducing all the expenses, including interest expenses, including tax and operating expenses and everything. That is the bottom line of profitability. Net profit margin show the percentage of revenue that remain after deducting all expenses, including operating expenses, cost of goods sold, interest, tax, and it represents the company's bottom line profitability. That means the final profit that available to distribute to shareholders. So then for formula for net profit margin is net income divided by sales into 100. So let's look into an example. So just assume that one company have net profit margin 15% and company B have net profit margin 8%. Even if the same level of revenue, company A is more profitable after covering all its costs, interest and tax. Company A is generating 15% net profit to its sales, whereas the company B is generating only 8% of its sales into as net profit. Company A is more effective or more efficient in managing its profitability, it's managing its cost and improve and operating with a improved profitability when it's compared to company B. So we'll move into next ratio, that is EBITDA margin percentage. EBITDA shows the margin profitability before interest, tax and depreciation, also amortization. It focuses on operating cash flow potential, ignoring accounting adjustment like depreciation. EBITDA mean earning before interest and tax, depreciation, amortization. It's focusing on the operating income before adjusting depreciation and mainly the depreciation and amortization. So it is telling EBITDA telling how much operating profit we generate without considering depreciation and amortization, because the depreciation and amortization are not the cash expenses or it's not related to cash flow. So it's mainly focused on the operating cash flow potential. So the formula for EBITDA margin is EBITDA divided by sales into 100. That means it is telling how much proportion of sales is the EBITDA. Whereas EBITDA means operating income plus depreciation and amortization. Because in the EBITDA, we are not considering depreciation and amortization as expenses because which is not related to operating cash flow. So to get the EBITDA, we have to add depreciation and amortization with the operating income. Let's discuss through an example. So in this case, the sales is 900,000, EBIT is 100,000, depreciation 40,000 and amortization 10,000. So in this case, the EBITDA mean 100,000, that is operating income plus this depreciation and amortization, that is 150,000. So the EBITDA margin in this case is 150,000 divided by 900,000 into 100, that is 16.7. So which means this companies generate $0.167 of cash-based profit for every $1 of sales. So let's see what is the difference between net profit margin and EBITDA margin. In the net profit margin, it is considering all the costs, including depreciation, interest and tax, everything. But in EBITDA, it is ignoring financing and non-cash charges useful for combining companies with different capital structure. So the EBITDA is very useful when we are comparing two companies with different capital structure, because in EBITDA, the financing costs are not considered. So if you ask to which ratio is the best for comparing firms across countries with the different tax system, even if you are using net profit margin with two companies having different tax system, it may not be an apple to apple comparison. If we are using EBITDA, it will be a better comparison if we are comparing two companies or two countries, companies of two countries which having different tax systems. So we will move into next category of ratio, that is return ratios. Return ratio mainly measures how much profit this company is generating with related to its investment in asset, equity or in capital. So there are some key metrics to analyze. The first one is return on assets. Return on assets simply measures how much profit, net profit is generate when it's comparing its average total asset. So the formula for return on asset is net income divided by average total asset. So let's look into this case. So in this case, the net income is 80,000 and average total asset is 400,000. So the return on asset in this case is 80,000 divided by 400,000 into 100. That means 20%. So what is mean that this company is generating 20% of profit per $1 of asset. Let's assume if this company have $1 in asset investment, this company is generating 20 cents as net profit. So this return on asset is specifically useful for when we are comparing two companies or we are analyzing the trend over the time. Normally, a higher return on asset is obviously is preferred because it indicates the effective utilization of assets. So the next ratio is return on equity. Return on equity means it's generating how much income is generating when we are comparing with the equity. So the formula for return on equity is net income divided by average shareholders equity. So let's look into this case. In this case, the net income is 100,000 and average equity is 500,000. So the return on equity is 100,000 divided by 500,000 into 100. That means 20%. So what it means that the shareholders earn 20% return on their investment. So in this case, we are comparing net income with the shareholders equity. So what is measuring that? How much return shareholders earned based on their investment. So we move into return on common equity. Return on common equity is almost similar to return on equity, but in this case, we are removing the preferred stock or stock except common equity. So in this case, we are considering only the return for equity, common equity shareholders. So the formula for return on common equity is net income divided by preferred dividend divided by average common equity. So in this example, in this case, net income is 120,000 and preferred dividend is 220,000 and common equity is 400,000. So in this example, the return on common equity is 120,000 minus this preferred dividend we had to remove because in this case we are considering only the return to common equity shareholders divided by 400,000. That means 25,000. So what is interpret that the common equity shareholders earning 25% of return or this company is earning 25% of return on common shareholders equity. Let's move into next ratio, that is return on capital invested. So the formula for return on capital invested is net operating profit after tax divided by invested capital. In this case, we are considering operating profit after tax we are comparing operating profit after tax with invested capital. So let's look into this case. In this case, EBIT is 150,000 and the tax rate is 30%. So to calculate the net operating profit after tax, this is the formula. You have to deduct the tax from the operating profit. So the net operating profit after tax is 105,000. So in this case, just assume invested capital is 700,000. So the return on capital invested, the formula is net operating profit after tax divided by invested capital. So in this case, 105,000 divided by 700,000. That means 15%. So what is measured that, what is interpret that this company is earn 15% of all invested capital. That means all capital providers, including debt, equity, and everything. So which means on returned investment or returned capital, this company is generating 15% return. So we have discussed now the return on asset, return on equity, return on common shareholders or common equity, and return on invested capital. So in return on asset, it's measured efficiency of asset utilization. Return on equity is measuring the return to all equity shareholders, and return on common equity is measured the return only for the common equity shareholders. Return on invested capital is measuring the total investment, which is considering debt and equity, and it's measuring the profitability or return of invested capital. So now we will move into the revenue analysis. That means factors to be considered in measuring income. Profitability ratios are meaningful only if income measured correctly. Several factors affect how income is reported and analyzed. So there are some factors we have to consider when analyzing and when measuring the income in financial statement. So that means the source, stability, and trend of the revenue. So before considering a income or revenue for analysis, we have to make sure that this revenue is from the core business operation. That means, is this revenue from core business operation, or is the sale of product sales or non-core activities like sale of asset or investment or income. In some cases, what can happen, for a certain period, there will be, just assume that there is a sale of assets for a profit. So in the income statement, this can be also treated as a revenue or income, but this is not a stable income, or this is not a income from the company's core activity or core operation. So for the revenue analysis, or the quality of, when we are considering the quality of revenue, this outside sales or not core activity sales or investment is not considering when we are analyzing the income. For example, a manufacturing company should mainly earn revenue from its product sale, not from selling building. Just assume the manufacturing company should earn revenue from its product sales, not from selling the building or any other assets. This is not the core business activity of that business. So that means, when we are analyzing income, this has to be considered. That means the source of that income, whether this income from the core business activity or not from the core business activity. So for the analysis, for the return purpose analysis, the income from core business activities only should be considered. The next thing up is stability. That means, how stable this income. Volatile revenue raise risk. Example, a subscription-based software has more stable revenue than a seasonal toy company. Just assume a subscription software-based company, it should have more stable income than a seasonal-based company. That means, for the seasonal companies, there should be some up and down in the sales during a period of time. So this is very normal for a seasonal based company, but for a steady revenue company like a subscription based or non-seasonal business, the revenue should be stable. The trend. Next part is the trend. So we should analyze the trend of the revenue for a period of time. That means, if when we are analyzing the sales revenue over a period of time, whether it is improving or whether it is declining, normally the increase in sales or increase in revenue is considering as a positive trend. So when we are analyzing the revenue, these all things, the source, stability and trend of the revenue has to be considered in the analysis purpose. So the next thing is relationship of revenue and inventory. This is mainly measuring how much inventory company is maintaining when it's related to its sales. For example, raising inventory faster than sales may indicate overproduction or unsold goods. In a company, if the inventory is increasing more than sales, which indicate that there is an overproduction or unsold goods in the inventory. For example, sales increase 5%, but inventory rise only 20%. There will be, what we can analyze, that in this company there is a possible demand slowdown. So when we are analyzing the revenue, the inventory also has to be considered. How much revenue generating from maintaining which level of inventory. Just assume the inventory level increased by 50% and the revenue is increased only by 10%, which means there is a mismanagement, or there should be a lack of control in inventory management. Again, the relationship between revenue and receivables. Again, the same thing. If receivable growing faster than sales, it indicates a poor collection process. A company growth its sales 10%, but its receivable grown more than the sales, it means that there is a issuing with the collection process or collection policy. So saying like that, there are different revenue recognition policies also. This is very relevant when we are comparing companies with the two structure or two operating structures. For example, a company is recording its transaction in GAAP and another company is recording its transaction in IFRS. When we are comparing these two companies, the revenue recognition policy has to be reviewed. For example, so not only the accounting policies, if the companies are operating in different sectors, again the revenue recognition principle or policy can be changed. For example, A software company may record revenue immediately or spread over its subscription period. There is a two method for a software company to record its subscription revenue. Maybe in some as per some standards can be recorded immediately if there is no provision to return the revenue. But in some cases, it can be recorded at the end of that period. Is there is a there is a provision to return that revenue if the customer is not satisfied. So this revenue recognition policy has to be considered when we are evaluating sales or revenue. Again, classification of expenses. The income statement is a income statement have a structure like it's have a gross profit, operating profit, and after it is coming into net profit. So in all these profit level, there are different costs as cost structure is covering. Like gross profit, it is covering only the direct costs like production cost, manufacturing cost, direct labor, direct material and manufacturing overhead. But in the operating profit level, it is covering all operating expenses related to operational, all operational expenses. But in the net profit, it is covering all the expenses, whether it is operational, administration and selling or any other expenses, interest or all these expenses is covering in the net profit level. So this categories expense should be classified properly. Just assume, for example, if interest is wrongly included in the operating cost, just assume that by mistake interest is included in the operating cost. That means the operating margin look weaker. That means the normally interest is not coming under the operating profit level. It will come under the net profit level only. So if you mistakenly added interest expenses in the operating cost, the operating cost margin may look weaker. So we'll move into sustainable growth rate. Sustainable growth rate is the maximum rate which a company can grow without raising additional external capital. It depends on how much profit is retained in the business. And the sustainable growth rate is measuring how much a company can grow without raising additional external fund. That means how much profit a company is generating and how much of the profit that company is retaining that profit into the business. That means how much profit that company is generating and how much profit that company is retaining in the business for the growth. So the formula for SGR is return on equity into 1 divided by dividend payout ratio. This 1 divided by dividend payout ratio means this is dividend retention ratio. So just look into this case. In this case, the return on equity is 20% and dividend payout ratio is 40%. So in this case, the SGR or sustainable growth rate is 20% into 1 divided by 40. That means 20% into 60%. That means 12%. So what it measures that this company can grow 12% its sales and asset without adding new financing. So why this is important? This help assess where company growth is sustainable or require extra capital. That means which help this SGR is helping to measure this company can grow sustainable or it's required extra capital to grow. If company grow faster than its SGR, it may need debt or equity. Just assuming this case is the company is planning to grow 20%, that means this company require additional capital. So with this SGR, this company can grow only 12% only. So if the management is planning to grow this company more than 12%, so it required additional capital or equity, additional capital. Just assume this company growth potential or is company is growing slower than SGR, this company may not be fully utilizing its potential. So let's conclude this discussion. So what we discussed today is the profitability ratio. So where we discussed some important ratios like GP margin, gross profit margin, which measure the profit a company earned after covering the direct cost of production and show how efficiently it's managing the cost of goods sold. So in the operating profit margin, measure the profit remaining after all operating expenses and reflect the efficiency of the company's core business operations. In the net profit margin, it measures the profit remaining after all expenses, including interest, tax, and indicate the company's overall profitability. In EBITDA margin, it measures the profit while ignoring non-cash charges like depreciation and amortization, and it's useful for comparing companies across different tax and financing structure. The return on assets show how efficiently a company uses its asset to generate profit. Again, the return on equity measure the return earned by shareholders on their investment in the company. So the return on common equity measure the return earned by common equity shareholders after accounting for preferred dividend. Return on invested capital measure how efficiently all capital providers, including debt and equity holders, earn return after the company's investment. Earned return from the company's investment. Then we came to revenue analysis. Revenue should be analyzed based on its source, stability, and trend to understand its impact on profitability ratios. Then the relationship between revenue, inventory, and receivable is very important because the change or the trend of all these should be compared with the revenue to see the inefficiency and collection issues. Revenue recognition policies affect reported profitability since the timing of revenue recognition can change your financial result. So the next point, the proper classification of expenses between operating and non-operating item ensured accurate calculation of profit margin. Then we are discussed about the SGR, which indicate the maximum growth of a company can be achieved without relying on additional external financing. So finally, the trend analysis of profitability ratios over multiple period helps identify improvement or decline in performance. So this is about today's discussion, the profitability ratios. So if you have any doubt or need any clarification on any of these topics, please comment on the comment section. And also I am giving downloadable link of this PDF material in the description. Thank you for watching this video.